Yeah. Okay. So let me make sure. Oh, okay. Happy Thursday, everybody. Yeah. Okay. So let me make sure. Absolute, absolute. That's wonderful. Okay, awesome. So, anyways, let me just go through again. Again, happy Wednesday, everybody. You're welcome to the show, whatever part of the world you're watching at. Why don't you drop us a like in the comment? Also, let me know where you're watching from, right? Because one of the things that happens is that most people really think investing is just about picking the right stock or ETF. But you know what? In a taxable brokerage account, the real enemy is not usually the market, it's usually taxes. And that's one of the things I really want to talk to you about today, how to maximize your taxable brokerage account. Because you can pick great investments. You could even grow your portfolio to hundreds, millions of dollars and still lose thousands of dollars every year on the back end simply because your portfolio is not tax efficient. Again, I'm not a tax expert or anything, but I want to talk to you how to leverage the different portfolios you have in order to minimize your tax damage. And one of the things that happens is that most investors don't really have no idea that they are doing it wrong. So today I want to break down the tax smart ETF strategy that serious investors like you watching me are supposed to be paying attention to. Okay? Serious investors like you who are watching me, this is what you have to understand. You have to pay attention to this ETF strategy that I'll be breaking down to you tonight. Now, I want to know if you are on call with me right now. I want you to drop what city you're watching me from, right? Let me know exactly what city you're watching me from. And then that way, too, I'll be able to give you a shout out and know exactly what's happening. Let me know exactly what city you're watching from. That's awesome. So let me see here. Let me just, I just want to make sure I can hear myself so that way I don't, I can see. Okay, let me see here. Let me see. That's good. So tonight, this is what we're going to do. We are going to cover the ETF categories that work best in taxable brokerages. We're also going to look at the ones that you should avoid completely when you're investing in taxable brokerages. And we're also going to look at how to structure the portfolio that is built for long term compounding. But you also need to remember something. It's not just that you earn in the market, it's what you keep after taxes that matters, okay? Because let's break it down. As you probably know by now, there are two things that are certain: there is death and then there is taxes, okay? So, death and taxes, those are the two things that are certain all the time, right? So, let's break it down here. Investing inside a taxable brokerage account is very different from investing inside a 401k or an IRA or a Roth IRA. And I want you to understand that, or a 4 or a Roth 401k. Understanding these differences can really help you build wealth faster and, most importantly, put you in a more tax efficient place. Before choosing investments, you must understand three key realities. All right. Number one, the biggest difference is taxes, and retirement accounts have major tax advantages, no question about that. A 401k, a traditional Roth IRA, these are tax deferred growth accounts. So basically, you don't pay taxes on the growth of the money. The taxes are deferred until when you are ready to start withdrawing the money from those accounts. That's when you pay taxes on it. That's why they are called tax deferred accounts. Now you have a Roth IRA. A Roth IRA is one of the most powerful financial tools in the financial ecosystem in America because the Roth IRA is an after tax growth vehicle. So it's basically a tax-free growth vehicle because the money you invest in the Roth IRA has already been taxed. And so the growth of that money too doesn't generally get taxed when you start withdrawing it, if you are withdrawing it at the qualified age. You must understand there's a certain age that you can qualify to start withdrawing money from the Roth IRA without it being taxed. So that means your investment really grow without annual taxation. But you also have to understand something here, guys. The taxable brokerage account works completely different. These accounts I just talked about, these are tax deferred and tax-free accounts. The taxable brokerage account works completely different because you are going to pay taxes when a few different scenarios happen. Number one, If you sell an investment at a profit, you are going to pay taxes on the gains, not on the total sale. This is something very important to understand because a lot of people get confused. You are going to pay taxes on the gains in a taxable brokerage account and not the total amount. Number two, if you receive dividends, there are some ETFs and there are some companies that actually pay their stockholders dividends. What is a dividend? A dividend is a bonus that a company pays you for holding their shares and their stocks. So companies like McDonald's, companies like Walmart, companies like JP Morgan Chase, companies like ExxonMobil, companies like Procter and Gamble, these are traditionally high dividend paying companies. So every quarter, every 3 months, they will send you a payment. And as an investor, you can decide on one of two things. You can tell your portfolio, you can set it up in your portfolio in such a way that those dividend payments come as cash payments to you and it will be sent to your account. Or you can say, you know what, I don't want you to pay this money to me. I want you to use those dividends to buy additional stock of that company. That is what most people do. That's what I coach my clients to do. The reason why is because it is money you were not expecting anyways. So why don't you just reinvest it in stock? And that is how your portfolio grows faster and bigger over time. Another thing you have to realize, some ETFs, not too many, they redistribute their capital gains from time to time. So they give shareholders bonuses. So for example, if you buy a stock for $100, right? And let's say after 2 months or 3 or 4 months, it rises to $150. You sell that stock, you owe taxes on just that $50. You don't owe taxes on the entire $150, right? So if you receive dividends too, you may owe taxes on those dividends. And I'm going to talk to you on some of the qualifications. Because of this, tax efficiency matters a lot in taxable accounts. It is important because taxes are going to be a big chunk of part of that if you don't understand how it works. So today I want to talk to you about that. So when we are talking about dividends, we have two different kinds of dividends. We have qualified dividends and not qualified dividends. What are qualified dividends? Not all dividends are taxed the same. Qualified dividends are taxed at a lower capital gains rate, somewhere between 0 to 15%, okay? Non-qualified dividends are taxed as ordinary income. So if you receive a dividend, maybe from Walmart or from JP Morgan Chase, it depends, right? If it's a qualified dividend, then you will get taxed. The maximum you can get taxed for that is 15%. But if it's a non-qualified dividend, and there are some regulations and rules around qualified and non-qualified, I don't want to get too much into those deep stuff. I just want you to have an understanding, right? But if it is a non-qualified dividend, you can get taxed even all the way to your ordinary income tax bracket. So let's say your ordinary income is 27%, you can get taxed at 27% for that particular dividend. So it's important to understand this, right? That is why some popular high-income ETFs are not ideal for taxable accounts, because these popular high-income dividends are ETFs that target companies and they target making income. So they pay high dividends. But the challenge is if you have those kind of ETFs in your taxable brokerage account, then you tend to pay a higher amount in non-qualified dividend taxes, right? So it's not only enough to know what dividend to buy, but it's also important to know what kind of portfolio and brokerage account and what kind of account actually to invest and position that kind of the ETF or those kind of companies in. So for example, there is a JP Morgan Chase high income ETF called the JEPI. It produces very high dividend, but most of it is non-qualified, meaning the tax bracket for those dividends will be higher. It will be taxed at your income bracket. Now, if you're somebody that has a lower income bracket, that is an advantage for you. But if you're somebody who has a higher income bracket, then that will be a disadvantage because you pay a lot more taxes on the dividends for that. So these types of ETFs are best suited for retirement accounts, not taxable brokerage accounts. For retirement accounts where the tax is deferred for a later time down the line when you get older or when you need the money, when you qualify, right? So these are some small nuances that are important to understand because it positions you in a place where you can better understand how to go about investing. So in this video today, if you stay with me in this live stream, I want to talk to you about the best ETFs to invest in your taxable brokerage account. We are not talking today about your 401k. We are not talking about Roth IRA. We are not talking about any of those retirement accounts. We are talking about a normal brokerage account, which is like your Fidelity account, your Vanguard account, your Schwab, your Robinhood account, your Coinbase account, those kind of accounts, right? What you should prioritize, and I want you to listen to me carefully, especially for taxable accounts, you want investments that have a few qualifications. Number one, you want investments that have tax efficiency, tax efficient investments. So these are investments that either have low taxation rate or over time the tax rate reduces. You want investments that produce qualified dividends so that you can pay taxes up to 15% and not more. Number three, you want growth through capital appreciation. So in your taxable brokerage account, you want to invest in assets that grow with capital appreciation. The reason why is because capital gains taxes are also capped at a certain amount. And in recent times, Donald Trump has been talking a lot about reducing the capital gains taxes. That is going to help a lot of people, right? Because if he reduces the capital gains taxes, let's say he pushes it down to, I think he was talking about 10% maximum or something. That is fantastic. It means no matter the profits you make on the capital appreciation of an asset, you can only pay up to 10% in taxes. So you make 100,000, you pay only 10 grand, right? But presently, I think capital gains taxes, the max is about, I think about 20% or 25%, something like that. I just need to validate that again. But I want you to understand the concept. Don't get caught up with those numbers yet, right? You want to invest in your taxable brokerage account in assets that have high capital appreciation. Now, this leads to a portfolio built around 4 ETF categories, okay? And let's look at it. Let's look at the categories of the kind of ETFs that you want to invest in your taxable brokerage account. The first category of this kind of ETF, we are talking about the dividend value ETF. And what is the purpose of the value ETF? And by the way, if you are just joining us, feel free to drop your questions down in the comment if you have any questions. Let me know what city you are tuning in from. I would love to know what part of the world you're watching today, right? Leave us a comment, leave us a question. If you're watching on YouTube or Facebook, give me a like. It doesn't cost you anything, but it helps me a lot, okay? Because that is how this thing gets moved now to other people, so other people can actually watch it. So give me a like, guys. So we're talking about the first category for your taxable brokerage account, and this is the value ETF. Now, what is the value ETF? The value ETF is basically a dividend value ETF. It's an ETF that is geared towards producing income through dividends, right? Generally, this kind of ETFs have lower volatility because the kind of companies that are part of this ETF are companies that are mature, are value companies that don't grow too fast, and they are not too volatile. Remember, an ETF is a basket of stocks, right? And so a lot of the companies too that form part of the value ETF are companies that are recession resistant. So these companies, it doesn't matter the economic circumstance, they generally do okay. They don't grow too fast, they don't drop too fast, they just keep sailing on a constant, right? These are generally companies too that have paid dividends consistently for many years, 10, 15, 20, 25 years. Now, these dividends generally hold mature companies. These ETFs, sorry, hold mature companies. We're talking about companies in like the consumer staples industry. Consumer staples, we're talking about companies like Walmart. We're talking about retail companies like maybe Target, right? We're talking about healthcare companies. Healthcare companies, these are hospital systems. These are companies that produce healthcare products, companies that produce diapers. You are talking about companies like Procter and Gamble, right? Colgate Palmolive. You are also talking about utilities companies. Utilities are the companies that provide your lights, your water, your sewage disposal. These are companies, it doesn't matter the economic circumstance, they are going to be okay, right? Because we need these things, we use them, it's not luxury. So these companies actually form part of that value ETF because they don't move. An example of a value ETF is something like the Schwab US Dividend Equity, so SCHD, right? Another example is VYM. And these are all dividend value ETFs. Now, another important thing I'll be talking about while I'm talking about these ETFs is also their expense ratio. The reason why is because expense ratio is very important, right? The expense ratio is the cost of managing that ETF. Even though ETFs are generally cheaper in management than mutual funds because they are passively managed, but there is a cost to it. So for something like SCHD, the cost of managing it is 3%, which means for every $10,000 invested in that ETF, $3 of those $10,000 will be used to pay the people who are managing those ETFs, right? But the most important thing I want you to understand, especially when it comes to value ETFs that pay dividends, you want to elect to make sure that the dividends that are paid are being reinvested in the ETF, because this does something we call the dividend snowball effect. What it means, let's take, for example, right? SCHD produces averagely about 3% in dividend annually. So if you have $10,000 invested in SCHD, at the end of the year, by the end of the year, you would have received $300, and they pay you that every quarter, every 3 months. You would have received $300 in dividends. Now, a single share of SCHD, I think, is somewhere about $25 now or 24. I'm not sure. I didn't check it today. So with those $300, you could either request that they send you the money and you go buy something with it, or you could choose that, you know what, I am going to reinvest it in buying more shares of SCSD. That is a better option because it starts building that snowball effect. You take the 300, let's say the shares are $25, so you can buy about 12 of them, right? For that 300. Now those 12 shares now will start also producing their own dividends. And you see, you take that dividends now and you buy more shares in addition to the previous 300. So your portfolio gets bigger. That is why reinvesting dividends is very powerful in portfolio growth, right? This is called the dividend reinvestment snowball effect. Now let's talk about the expense ratio. The expense ratio for SCHD is actually 0.06%. So that's about $6 per $10,000. Average annual returns so far over the last 10 years has been somewhere about 12 to 13%, right? The Vanguard high dividend yield, which is similar to SCHD, the VYM, that is also the same kind of product but just run by Vanguard. The expense ratio is the same, $6 for 10,000, and it has grown by about 10 to 11% averagely over the last 10 years, right? So that is it for the value category. Let's talk about the second category of advantageous ETFs that you can invest in your taxable brokerage account and why it is advantageous to do that. Let's talk about the second one. Foundational market ETF, and this is a very powerful one because it's important to understand why it is important, right? It's a very important category of ETF because this is the engine for long-term investing, right? This is the foundation of everything you're trying to build when you're investing on the stock market. Think about building a house. When you're building a house, you start with the foundation. If the foundation is not solid, it doesn't matter how much you spend on the walls. It doesn't matter how much you spend on the roofing. It doesn't matter how much you spend on the ceiling or the staffing. That house is going to collapse because the foundation is not stable enough, right? So I want to talk about the second category, which is the foundational ETF category. This is really the engine room of your investment strategy. These ETFs generally track either the broad market or they track a component of the broad market. Let me give you the two examples in this category. Excuse me. Number one, and I want to give you some historical context too, right? You have one of them which is called VTI. VTI is a broad market ETF. VTI tracks the entire US stock market. And then the other one is VOO. And by any means, these are not recommendations to buy, hold, or sell. These are just conversations I'm having. This is my tutoring, and I'm sharing with you some of the things I do You can do your own due diligence. If you need additional help with understanding some of these things, you can always look on my channel. You can book a one-on-one appointment and we can work on it together. But I need you to understand, the most important thing is to understand the concepts, right? The concepts is what really is going to help you. Because in this business of investing, I'm not in the business of just giving you things to go and buy. It doesn't help you. What will really help you is understanding why you are doing it and the different things that you need to at different times in your financial life. So VTI covers the broad market. This contains over 2,000 different companies, right? And it basically follows the US stock market. VO covers the 500 top companies in America by market capitalization, and that is called the S&P 500, right? The S&P 500, these are 500 of the top companies in America by market cap. So VOO is an ETF that basically invests in these top 500 companies. So let me give you a little historical concept here, right? $100 invested in the S&P 500 in 1929 during the black market days, if you remember, right? It will be worth today about 889,000, even after the Great Depression, even after the financial crisis. And think about all the other things that have happened in this world between 1929 and today. So it tells you what? It tells you that the market is always going to outlive all the different geopolitical challenges that exist, all the different scare tactics that can be applied. Now, this also demonstrates the power of long-term ownership over of productive companies. That's why I talk a lot about you making sure you want to own assets in companies that are proven and can stay the course of time. Now, another very important thing to realize is an ETF like VOO, it has, over the last 10 years, it has averaged about 14.5% annual growth. So basically, it also has 0.3% in management fees, right? In expense ratio. So it means for every $10,000 you spend buying VOO, you're going to pay $3 to manage that. That is very cheap. That is very low for a management fee, especially for an asset that averages the last 10 years about 14.5% every year. That is huge. Now, if you look at VTI, which is the total market ETF, right? The expense ratio is 0.32, which means $3 for 10,000. The average growth over the last 10 years annually is about 13%. That is fantastic. But the power of this foundational ETF is that it gives you the capacity to have a stable foundation on which to run. And if you stay with me on this stream, towards the end of the stream, I'm going to give you strategies you can use to invest depending on your age. I'm going to give you a blueprint for free, guys. That's going to be for free. That is something I typically sell, but I'll give you that for free. All right. And you can look at your age bracket and you can get that as guidance on how you should invest at that age in your life. All right. So let's look at category number 3, the international ETF. Now, the international ETF, you must understand there are stock markets around the world. America is not the only country that has a stock market. I met somebody the other day, and the person was telling me that there's only one stock market, the New York Stock Exchange. I laughed so hard. I said, no, other countries have stock markets, right? Nigeria has a stock market. Cameroon has the Douala Stock Exchange. Recently in Cameroon, BGFI, which is an international bank, was selling some shares of its companies. Ghana has a stock market, South Africa, Morocco, Egypt, Germany, France, all of these places, Asia, Singapore, China, right? But you need to understand something. The US stock market is the largest by market capitalization and is the most attractive stock market because it's the only stock market of all the stock markets that consistently produce profits. 78% of the time, the US stock market will go up. Only 22% of the time is it going to go down. So if you really want to invest for gains over a long period of time, your odds are best investing in the US stock market. And I need you to understand something. I will talk about category number 3, which is the third category, to invest in a taxable brokerage account. And this is an international ETF. Now, the purpose of the international ETF is simple. It's to give exposure to companies that are out of the United States. Number one is to also provide geographical diversification. So think about it this way, right? Imagine somebody who was invested only in companies that are located in Iran, for example. I'm just taking that as an example, and with all due respect to the Iranian people, right? Now, because of the geopolitical tension that they're having, right? Those companies are at risk. So if you had all your investments in a company that is geographically located in one place, it puts you at a geographically risky point. So you must understand the international ETF also provides geographical diversification because you'll be investing in companies that are scattered all over the world. Some of them are in Asia, some of them are in Africa, some of them are in Latin America, some of them are in the United States, some of them are in Canada, England, France, different parts of the world, right? So an example of this ETF is something called VXUS, which is the Vanguard Total International Stock. It has about 8,000 companies in that ETF. You have companies like Taiwan Semiconductor. You have companies like Mitsubishi, Samsung, Tencent, ASML. You have Novo Nordisk. You have all these different companies from different parts of the world, right? And here's the deal. Historically, and I want you to pay attention to me here, right? The last year, the international ETFs, most of them have beaten the S&P 500, right? But I want you to understand when you are investing as an investor, you are playing the long game. In the long game, the international ETFs don't really perform as good as US-based ETFs. The VX US has averaged in the long term, averages about 6% in annual returns. If you distribute its returns over the last maybe 10 to 15 years, right? That doesn't even beat the S&P 500, which averages about 10%. So yes, you want to have international exposure because it helps you with geographical diversification. It helps you to provide access to companies that otherwise you will not access them because they're not in the US. But you also have to remember that it comes with the downside risk of the fact that it might not grow as fast as other opportunities. So you might have to consider the percentage of your portfolio that is invested in this ETF. Therefore, your international exposure should usually remain a smaller portion of your portfolio. Because don't forget that even the US companies you invest in, a lot of them also already have international exposure. A company like Apple, a company like Microsoft, it has international exposure. 94% of all technological products of computers around the world have a Microsoft product in them. That's international exposure, right? Apple has about 4 billion active devices working around the world. So you already have that. So even though you want the international exposure, you typically should consider the growth and realize that, you know what, it might not make sense to invest a huge amount in that. So now we have the VXUS, as I said, it averages about 6-7% the last few years. The expense ratio is $7 for every 10,000. Another international ETF is IXUS, and that is owned by iShares. iShares is another company, just like Vanguard, just like Fidelity. The expense ratio is the same too, $7 for 10,000, and it averages to about 7%. So international ETFs like VXUS and IXUS, they basically mimic each other, right? So you can see over a long period, they average about 6 to 7%. That is an important piece of adding to your portfolio, but it's important to recognize that they are not going to give you the kind of growth you might be looking for. So you don't want to make it a big part of your portfolio. Now let's talk about the fourth category, and this is the growth category, right? This is the fourth category. You want to invest in a taxable brokerage account, the growth category. In this category, you are looking at innovative companies, right? This category, a category of ETFs that have innovative companies like Apple, Microsoft, NVIDIA. This category is a category of high growth companies. An example of an ETF in this category is QQQM. QQQM is an ETF that invests in 100 of the top companies on the stock market, which are not financial companies. So it actually mimics the NASDAQ 100 because the NASDAQ 100 just invests only in the top 100 companies that are non-financial, right? So this one is the growth category because these companies are volatile, but they also can grow fast. And during difficult economic times, they can drop very fast. Like if you've been paying attention to the news the last 2 months, most of the companies that have been suffering significant drop in the market are mostly technology companies. And these are part of these companies that are in QQQM. Apple, Microsoft, Nvidia, Tesla, BBAI, all of these technology companies. So this is a growth engine for your portfolio. But you must also recognize that the only way you can benefit from this is if you do it for the long term. So that way it can weather all the different gyrations of the market. When the market goes up, comes down, it is not a problem, because over time you are going to generate a lot of growth with the growth ETF. Now let's see here. Generally, this growth ETF category over the last 10 years, it has averaged QQQM, the one I talked about, has averaged about 20% annually. That is significant, right? We also have VUG, which is a Vanguard Growth ETF. We also have SCHD, which is a Schwab Large Capital Growth ETF. These are all growth potential for the portfolio. So if you're trying to invest now in growth directed ETFs, these are some of the possible ones you can invest in your taxable brokerage account. And like I said at the beginning, the advantage is that the growth of the ETF over time will make the taxes that is going to generate worth it, because the taxes you will generate in your growth portfolio, which are capital gains taxes, are capped. So the growth will be significant and you'll pay a capped amount for the taxes. So that puts you at an advantage, right? So let's look at the growth, the expense ratio for QQQM. QQQM has a slightly higher expense ratio at 15%. At 0.15%. Sorry. That's about $15 for every $10,000. VUG has an expense ratio of 0.04%. That is $4 per year for every $10,000 invested. So you see the difference in the expense ratio. Then both of these ETFs generally invest in about the same thing. QQQM might have slightly higher growth because it has a lot more, right? It's a lot more concentrated on those high growth companies, and there are only 100 of them. VUG is slightly slower just because it has more companies than those technology companies. But both of them, QQQM would average about 19 to 20%, VUG will average about 18%. So there's a 1% difference. That is significant, but of course, both ways you're not going to lose, right? So these are possibilities for the growth category. Now let's talk about the final category, the fifth category, which is the fifth kind of ETF you should consider investing in the taxable brokerage account. And this is the aggressive sector ETF. Now this category carries the highest volatility levels. And these ETFs are focused on specific industries. So these ETFs are not like the other ones which concentrate on different companies from different industries. These ones are focused on one specific industry. It could be pharmaceutical. It could be some aspect of technology, right? So let me give you an example of that kind of ETF. There is an ETF called Vanek Semiconductor ETF, which is SMH. That is the ticker symbol. Semiconductors have generally averaged about 30% annual returns over the past decade, but they can also experience significant drops and swings when the market is tough, like a tough period like now. So if you are investing in the aggressive sector, which is like the semiconductor industry, in an ETF like SMH, you know that you are investing for a long period, knowing that even though there will be significant market swings, you will end up on top. Because this ETF should actually also not be a very big portion of your portfolio. You must understand. Remember, we have the value category. Then we have the broad market foundational category, right? If you remember very well. Then after that, we have the growth category, right? And then we have the aggressive category now. So you want to make sure, even though you want to participate in the aggressive, but you don't want to make that a big part of your portfolio, especially if you're already in your 40s, because you don't have as much runway for a lot of those variations to happen, right? So that is that for that one. Now let's see here. Let's see what the expense ratio is for the SMH. Because the SMH also has this high growth potential, of course, naturally, the cost of managing it is going to be higher. They have to make money, right? So the the expense ratio is 0.35. So that's about $35 a year for every $10,000. So if you have 100,000, it's $350 a year, right? But when you look at it relative to the portfolio, that's not bad relative to like a mutual fund, which can be 1% to 2% a year, right? Now we also have another ETF called the VGT, which is the Vanguard Information Technology ETF. This is also a specialized ETF around technology, high growth potential. Expense ratio is significantly less than SMH. The expense ratio for VGT is 0.10. So that's about $10 per year, right? Now, VGT averagely has grown about 30% in the last 10 years, averagely. VGT, about 23% averagely the last 10 years. Now, let's move forward here. Now, I want to talk about how to structure your portfolio considering these different categories by age, okay? And let me do something here. Let me just permit me share my screen. I think I would like to share my screen so that you can see exactly what I'm saying. That will be more helpful. Let me see the window. Let me just say, okay. Just sit into the screen here. Okay. Let's see what that says now. Okay. So, just confirm with me if you can see my screen, please. Awesome. Okay, let me just share this slide about this. I think it will just be easier if you can visually see it than talking through it as much. So here's the deal, right? So this is just an example. And again, I want to make sure we understand, right? I'm no financial advisor. I'm not your financial advisor. I'm just a person here sharing my experiences and educating people on those things. Investment comes with risk, and you have to do your own due diligence, right? When you do your own due diligence, of course, it permits you now to be able to invest safely and take decisions that are beneficial to you as an investor. So understand that and understand that it comes with risk, right? Now, just a second here. Let me do this. Okay. So let's say you are age 30 and younger and you're trying to build a strong, solid portfolio, right? You are looking at putting 25% into a dividend ETF, something like SCHD. Now you are looking at 30% in a foundational ETF like VOO. You are looking at 5% in the international ETF. Remember, I mentioned the fact that the international ETFs over a long period don't outperform the S&P 500. So you don't want to invest a lot in it. You are also looking at 25% in the high growth ETF, and which is QQQM, and you want to do 15% in the aggressive. And the reason why is you can afford to invest this significant into the high growth and aggressive, even though they have a high level of volatility and higher risk, is because you are young. You are 30 and below. So you have time. The market will recover. The market will grow. Even if it drops, it will still grow. So it gives you time to grow. Let's make progress. Now, if you're in your 40s to 55, right? And again, this is not advice or anything, but this is just guidance for you, right? Think about it. Now you realize that in this age bracket, instead of the previous one, which was 25 for the foundational, in this age bracket, it is actually 33%. And the reason why is because you are no longer a spring chicken in this age. You don't want to be too aggressive and you don't have enough time for the market to recover and for you to recover, right? So you want to do 33% in the value ETF, 25% in the broad market, 10% in international ETFs because they have lower volatility, and then 22% in growth and only 10% in aggressive tech, right? Now let's make progress here. In this case, now you are nearing retirement. Remember, I talk about the 4 quarters in life, right? 0 to about 25 years, you are preparing. That's the time when you're still getting to understand you are going to school, you're finishing college, you're starting your career, and that kind of stuff. 25 to 35, that's your first quarter. 35 to 45, that's your second quarter. 45 to 55, that's your third quarter. And 55 to 65, that's your fourth quarter. Anything after that is overtime. Are we together? So you don't want to be the one where you are taking a lot of risk in your fourth quarter, which is the age of 65, because at that point, you don't have too much time to recover, and you really should not be taking certain kinds of risk. That is why if you are nearing retirement, this is how your portfolio should kind of look like. 50% in dividends, because that is less volatile. It's not too risky. It's not going to grow fast, but you're not going to lose money either, right? It's going to be stable generally. You want to put 20% in a broad-based foundational ETF like VOO, another 15% in the international ETF. And then you want to put another 15% in the growth, because even though you are nearing retirement, but you also want to make sure the portfolio is not just made up of the ETFs that are not growing. You want a little bit of growth, but more of stability. In this particular dispensation, you don't have no business with aggressive sector exposure. You don't want to do that because it's not going to serve you much. Now, the reason why I wanted to share this was because I want to make sure that, that it gives you a certain amount of, it gives you at least it gives you a visual that you can see, and it can help you to be able to know how to structure these things. All right? That's why I was sharing that. I hope that made sense. If you have any questions, please drop any question you might have in the comment section. But you know what? Here is the deal, guys. Here's one of the things I want all of us to remember at the end of the day, right? A taxable brokerage account is a very powerful tool. It's a powerful vehicle for wealth building. I understand you might have a 401k, you might have a Roth for IRA. That is good. But a taxable brokerage account also is an important piece of your financial planning and your financial war chest. Because number one, money is accessible in that account anytime. Your retirement accounts, money is not accessible to you from your 401k unless on special circumstances, or if you take it out, you're going to pay penalties, you're going to pay taxes, all kinds of things. But the brokerage account, generally money is available to you anytime. There are no early withdrawal penalties. In retirement accounts, if you withdraw your money early, you pay penalties. But taxes must be managed carefully. That is why I talked to you today about the different ETFs and the different categories that are best to invest in your brokerage account. Now, you want to choose ETFs that are diversified, that are tax efficient, and are built for long-term compounding. Because wealth is not built by reacting to markets, like I always tell you. It is built by owning productive assets for long periods of time. So if you're trying to invest, to build wealth for the long term, guys, you cannot afford to be building that with a short-term mindset. Short-term builders generally don't earn well. The reason is not because they are not smart enough. The reason is because nobody has mastery of the market. Nobody knows what is going to happen tomorrow. The only people who win with investing are people who invest for an extended period of time, because the market, as I say, generally goes up. So if you invest long enough, there are the greater odds that you will be on the wave with the market going up when it's going up, right? So I want to invite you, if you are joining me for the first time, please subscribe to the channel, give me a like, share this video with other people who might be interested. And I know many of you are listening, and I hope this didn't confuse you much. If you feel like you're overwhelmed, you feel like you need any kind of assistance to hold your hand, to walk with you on this journey of wealth building, because you know what? Ignorance is very costly, it's very expensive. But you know the most expensive thing? The most expensive thing is actually doing nothing. I want to encourage you that if you're actually considering doing something, you have been thinking about getting yourself structured properly, getting some assistance with working on those things, you can reach out to me, because you can book a one-on-one appointment with me. There's a link down in my YouTube channel and on Facebook descriptions. In that one-on-one meeting, it's going to be for an hour. In those 60 minutes, we are going to sit down and look at a structured diagnostic session, which is reviewing your current capital structure. I want to look at their investment strategy. I'll look at the risk gaps. I'll look at their portfolio positioning, including AI exposure, because AI is the leading technology today. And a lot of people don't know how to invest in AI. I will help you with all of those things and a strategic alignment. So this is not really going to be a coaching call. It's a structural diagnostic call, right? But a professional financial coaching architectural review. And after this, I'm going to give you a clean and clear step-by-step recommendation and plan on how to go forward. There is a fee for this, but a very small fee for the value you're going to get. All right. But I hope you certainly benefited from this live stream today. Again, if you have any questions, feel free to drop that. For the people on Instagram, for some reason, I'm not seeing your Instagram feeds today. If you have any questions, I'm sorry, I might not be able to respond. So I'm glad you guys are online with me today. I'm sorry my lighting is not the best. It's a little bit dark. The camera I usually use got bad, but I had to come in because the most important thing is the information. All this other stuff is fluff, right? It's just like a cake. What you eat on the cake is the actual cake. You don't worry too much about the icing, do you? I, for one, I don't care about icing. So I hope you have a wonderful evening. Make sure you take advantage of this public service information I'm sharing here, because you must realize you have yourself responsible for your life. Nobody is going to come to save you, right? We all know that already. Nobody is going to come to save you, not because people are wicked, but just because everyone else have their own problems they are dealing with and their own challenges. Our generations and the generations after us coming, we must continue to train ourselves with the mentality of independence, with the mentality of the ability to take ownership of our lives, with the mentality to understand that we cannot afford to continue to count on other people. I understand our continent, we were raised with certain things that try to tweak our minds to always rely on things, right? Remember, you hear they'll tell you 500 billion has been given to Africa in aid over the last how many years. So all of those things sometimes tweak our minds to believe that we must always count on something. The only thing you should count on is the grace of God. That's one, right? That's why I say you always pray like it all depends on God, but you work like it all depends on you. I want you to understand that. Work like it all depends on you, because when you do the work, then the grace will come to make it work, right? We must understand that in this time we live, in this era and the present dispensation we live, we cannot stumble our way through this life. We have to be intentional, we have to be focused, we have to be determined, but most importantly, you must remember that money will make more money on money than money can ever make on labor. Your body will never make as much money for you like the money you invest will make for you. I need you to understand that concept. Once you understand that concept, it changes everything in your life. It makes you understand why I talk about investing a lot, why I talk about building a legacy, why I talk about being able to organize yourself. Because the thing that is going to save you is not only your physical energy you're putting in. You are younger, you are putting in the energy, that's a good thing. But understand that your body is a single point of failure. At some point, your body will not be able to do the same. But there will never be a day when your money on the market will stop growing, unless America stops existing, unless they bomb the stock market and destroy it, which is not certainly a possibility in any time in the foreseeable future. So I want you to understand that, guys. The other thing, avoid unnecessary risk. Avoid unnecessary risk. I mean, you have people, anybody comes, proposes you any kind of business, you are quick to join. Why? For most people, you just invest on the stock market consistently. I give you a simplified, easy to follow system. You follow that system consistently, you are going to be very happy. You are going to be very successful. You don't need to do extraordinary things, guys. That is one of the things that affect us, because most of us coming into America are educated. 40% of immigrants coming into America have a GED. Another 24% have some kind of university education, including bachelor's degree. About 20% have advanced degrees beyond a bachelor's degree. So we tend to try to be too logical. We tend to try to think we need to overthink things. Don't overthink things, guys. Don't overthink it. Listen and listen very carefully to me, especially now. Usually, when the economy is lagging behind, that is when scams are very rampant. You are going to be receiving a lot of calls. You are going to be receiving emails from people who are telling you your email is going to be blocked. This is that. You are registered to win to 1 million. Please don't believe in those things. They are all scams. The only scam that you should, they are all scams. Sorry, don't believe in them. There is no scam that is geared to help you. They will come and tell you about a scooter company. Don't believe in that. They will come and tell you about things like Cloud Boost. Don't believe in those things. Oh, come, let's join this. You bring one person, this one brings this. We come in, we put this amount of money. This person will chop this. Guys, listen, be careful. You work hard for your money. Be very careful. I know what I'm talking about. I have enormous amounts of experience. I have been a director of marketing for one of the top network marketing companies in Africa. I've done network marketing in America. I have paid my dues earlier too when I came in scams. I remember the first year I came to America, they sent us an envelope. I was living at that time with my dear friend Elvis Tabukum in Minnesota. And we opened that envelope from the mailbox, and the envelope told us that we could get employed in a company where all we have to do is sit at home. They will send us letters and envelopes, and we fill those envelopes with those letters, we seal it, we put the stamp on the back, and then we go drop it at the mailbox. And they will pay us 50 cents for every letter we seal. So my friend and I discovered that, listen, if we seal these things, it will take us about 2 minutes to seal one. So we go work as nursing assistants. We do our 8-hour shift. Instead of doing a double shift, we come back home and we use the other 8 hours to seal letters. If one takes us about 3-4 minutes, and then in 1 hour we could do about, let's say how many? Maybe 12 of them, or not 15 of them. And if they pay us 15 cents, it means every hour, they pay us, sorry, they were paying $1.50, sorry, $1.50. It means every hour we are making about $17.5. And we thought that's easy money. We are sitting in our home, we'll be sealing letters. Now they told us, for us to start the business, we each need to drop $150. Remember, this is the year 2001, right? We need to drop $150. And in our mind, we are only focused on the fact that we are going to be making such easy money. So we dropped $150. These guys actually sent us an envelope, again, a big package with the instructions. We read those instructions, and the instructions kept turning us around and bringing us back to the same place. And we looked at each other and we said, God, we got scammed. We got scammed. Hey, hello, Jerome from San Antonio. My friend Gwen from Ohio, welcome on the show, right? We realized that we got scammed. And then I started learning a lesson from that time. If it walks like a duck, it quacks like a duck, it looks like a duck, it's most likely a duck. Let me tell you something, guys. I don't know of any other platform that has made it easy for average everyday people to build wealth like the stock market. Hear from me and hear from me very, very well. That is the easiest platform to build wealth if you know what you're doing. That's why I say don't try to, it's not gambling. Don't try to take unnecessary risks. Have a mentor. It doesn't have to be me. Find anybody else who knows what they are doing. Let them mentor you. Let them hold your hand. Let them help you. If you don't want a mentor, if you just want somebody to help set up your account and doing that, that too can happen. Let me tell you something, guys. Because the greatest losses you are going to have is not the losses you think you might have on the stock market. It's going to be the losses you have from doing nothing. I want you to hear me and hear me very well. It is going to be the losses you have from doing nothing. You see where the stock market is today. You see with the aggression going on in Iran and all these different things, the stock market has dropped probably double digits already over the last 2 months. Do you ask yourself, what has changed about Microsoft? What has changed about Amazon? All of a sudden, are there such bad companies? No, it's because people feel a certain way and they've sold their shares and prices have dropped. So the people who are buying those companies now, in 6 months, where do you think they're going to be? In 1 year, where do you think they're going to be? In 2 years, where do you think they're going to be? That is how you build wealth, guys. That's how you build wealth. That's why I spend evenings every day for 1 hour, 20 minutes, talking to you, educating you, making sure that you understand how this thing works. Because a lot of people come into this country, they work extremely hard. They get to 50s, 55, 60, they start getting frustrated because they don't have much to show, number one. And number two, they start feeling angry like people have used them in the course of their life. No, that's not the thing. Anything you want to do, understand something, guys. You are investing in companies that are proven. That's why I say, you know what? If you need help, you need to understand, you need somebody to show you the way, to give you a simple, repeatable, implementable system that you don't need to think out of the box. You don't need to worry yourself to set up your account, to make sure it is automated. We help with all those things, right? But even just the information you get from the videos I do live every day, that information alone, what I've shared with you today, somebody can use this template and go and start investing. You'll still be successful. I want to make sure you understand me. Go back to this live video after this. Look at the section where I talk to you about the different ETFs you can invest for the different age brackets. If you just invest in those strategies I talk to you, you are still going to be successful. You don't need nobody. I'm giving you the information free. Okay? I need you to understand, guys, the cake is big enough. Don't do stupid things. Don't go out there trying to make quick money. There's no quick money. You don't build wealth climbing an elevator. Wealth doesn't rise with an elevator. Forget it. You only can use the staircase. We tried to use an elevator and they chopped my $150. That's when I started understanding that in this world where we live, in the present dispensation, in the dispensation in the future, you're not going to make it that quickly. An average millionaire in America is 59 years old. All right? Most of the founders of the top companies around the world, a lot of them actually founded their companies, scaled their companies to billion-dollar companies after their 50s. I'm not saying you should wait till that time, but I'm just saying that sometimes we rush too much. Sometimes we rush and we get into stupid decisions, and we get into circumstances we were not supposed to get into. And we lose money. You are losing money. Investing on the stock market is not monopoly. It is real money. That's why you want to make sure you have mentorship. You want to make sure you have somebody who can guide you, because the cost of that person guiding you is a fraction of what you are going to make. And it's even a fraction of what you're going to lose if you don't do that. I know that because I lived it. Many years ago, I started investing too. I thought I was smart. I knew it all. And when I was buying some frivolous companies, within a few years, I had lost $80,000. My mentor was charging me simple $5,000 to teach me, to help guide me. And I thought that was too much. And I ended up losing 40 times that amount of money. Who is the dull person here? Who is the stupid one? Isn't it me? Guys, I'm just helping to give you guys a way of thinking about these things. Because sometimes one of the challenges we have as immigrants is that we tend to spend money on the things that don't make sense and try to be over smart on the things that make sense. I'm saying that. I'm just being honest here. The things that are going to help us, we tend to want to overthink it. The things that are not helping us, we are okay with that. I want to ask each and every one of you listening to me right now, go back to 2025. How much money did you contribute donating to baby showers, death ceremonies, this, that? How many? Think about it for a second. You do your own math for your own self. I'm not saying those things are not important. They are. I am just saying that, listen, guys, those things are not going to save you when you need someone to save you. What is going to save you is what you're able to invest and grow in your own portfolio. Let me tell you that. I believe in living as a community. I love it. I love our culture. I love the fact that we should help each other and things like that. But you know what? The more of us get this education I'm giving here, the more of us can invest on the market and build wealth, the less of us will need handouts. I'm just saying it up front. I'm just saying it up front. You can consider it whichever way you want. We cannot continue to operate on basis only of handouts. It doesn't work. It's not possible. We must understand how this thing works, right? We belong to a lot of associations. The other day, I was talking to a young lady who attended my webinar, and she told me over the last 3 years or so, she has been contributing to Jangis and things like that. Again, to me, Jangis are useless unless you are the first person to benefit, because you are getting a tax-free, interest-free loan. Other than that, what's the point in contributing money and getting it after 12 months when the amount of money has reduced because of inflation? Does that make any sense, guys? When that same amount of money could be generating 10% growth on the stock market? The only value of Jangi is the social interaction. Unless maybe you have a short-term project, you want to raise money to do something short-term. But it doesn't make sense to me. I belong to some just out of the beauty of wanting to stay close to my university classmates and, my high school classmates and things like that. But you guys need to understand these things. I belong to a high school classmate club too. We have an investment club in our high school classmate group. Ubuntu, 1994 classmate group. Our first cycle classmate group. We have an investment club, legal. We registered the club. We have an account in Fidelity. Every 3 months, each person, we've been doing that now for about maybe 7 years. Every 3 months, each person gives whatever, it's $100 or something. But do you know how much that account is today? Over the last 7 or 8 years, that account has grown to close to $300,000. We are barely 14 of us. So what are you telling me here? What are you? When I talk, I know what I'm talking about. I'm not talking here to impress nobody. I'm not talking to make anybody feel bad. I am saying that in this time we live, in this present dispensation, you must own your destiny. You must own your life. You joke, you are going to suffer, and you will suffer extremely. Right? So the only way for most people, everyday people like you, working hard, making money, trying to build significant wealth, is through the US stock market. Don't go trying to invest in some crazy ventures. Don't go trying to build some big apartment somewhere or some Airbnb yet. There is a time to do that. It's not now. You haven't generated the kind of wealth you need. Let me tell you guys something. Let me tell you something, guys. If you ask most real estate millionaires, they will tell you that they probably got their money from other ventures and invested in real estate to maintain and take advantage of the tax benefits. They are not really investing in it for profits yet. Real estate is great. Hear me very well. Real estate is very good, but it also has certain challenges for everyday people. The barrier to entry is very high. You need capital. Number 2, you need to find a good location. You need to find a good house, all those different things. Number 3, it is not liquid. Right now, I meet a lot of people who come to me for coaching and they tell me, you know what, I have $700,000 in equity in my home. It sounds great, but they don't have $10,000 in their bank account. Okay, go get the $700,000. Go get it. It takes some time, right? And it varies. If the value of the house drops or something, all of those changes happen. So what I'm saying is that a lot of people rush into these things. They don't understand that they have different seasons in their life when you invest in these different things. If you have a project, for example, to build an apartment building in Cameroon for rental or something, I'm just giving an example, in Ghana, in Congo, wherever it is. And I'm saying the same thing which I told a client of mine. I said, listen, if I am you, I am going to invest that money on the US stock market, and then I borrow against my investment at a small percentage, which is like 5%, and I go do that investment. That way, my capital in the US still keeps generating money while that investment is going on. Because if that one in Africa fails, it's not your hard-earned money. A lot of people get frustrated. You know why? Because the money they've used to invest in some of those ventures back in our continent, which is a good thing, it's money that they work for 10 years to save. So now they've put their sweat and blood into it. So if it doesn't work out, they feel hurt because it's their sweat and blood. But think about it. If that money was invested on the market and then the growth of that money is what you used to invest, even if it doesn't work out yet, you are not under pressure because you're not owing nobody. You don't have loans. You didn't borrow from nowhere. You know that it's a matter of time. If it's going to take 30, 40 years, fine and good. But the capital on this side is still growing. I don't know if somebody understands me. If somebody understands what I'm saying, I want you to put that in the comment section. If anybody understands what I just explained, I want you to put that in the comment section. If you want me to explain this concept in a different video this week, let me know in the comment section and I'm going to take some time to explain it. This is a concept, when you understand, it changes everything, guys. I want you to understand. We get carried away with a lot of emotional decisions, right? We must understand what the consequences are for some of these things. For most everyday average people, your number one way of building wealth is through having a business and scaling the business. The 70% of people aspire to own their own business, only 3% will do that. So that is very difficult for most people. Entrepreneurship is hard. The second way you build wealth is through the US stock market. The third way is real estate. The real estate involves multiple different things. Are you investing in real estate investment trust? Are you investing in single family homes? Are you investing in land? Are you investing in developing, buying the land, developing the home, selling them? Which area of it are you? It requires also some knowledge, understanding. It requires some capitalization. It requires all these different things, like everything. But I'm just saying that the easiest path for most people who don't want to do much is the US stock market. Because we set up an account, we automate that account, we give instructions for that account to buy certain companies and ETFs at certain intervals. And all you need to do is you keep doing the jobs you do. And your account will be funded automatically, and those investments will happen. Once every 3 months, once every 4 months, we get together, we look at it, and we see if we need to rebalance it. These are the things I am telling you, because these are the things some of us who've been around for a little while, we never got exposure to these things. That's why I'm very obsessed about educating people about it. Because from the day I understood these things, I realized if I knew these things when I came without doing anything, I would still have been very, very hyper successful. Right? So if you are listening to me now, don't just listen to me and go home. Take one thing and go implement it, guys. Take one thing, try to implement it. Take one thing, try to implement it. Make sure you put it into practice, because this is how you go forward. Start with a basic ETF. I gave you the strategy here. Go back and look at this video. Look at those ETFs I talked to you about. Look at their age bracket. Choose one or two of the ETFs that are within your age bracket. Go to the foundational ETF. Buy one of those foundational ETF. Start investing in it. If it's $50, put $50 every week. If it's $100, invest for $100 every week. Just keep doing that. That's how you win in this thing. Don't let nobody be fooling you about Social Security. That's not going to take care of you. Forget it. Forget it. The amount of work I have done in this country for the last many years, I worked. My Social Security check, they're estimating based on what they sent to me the other day, might be about $3,000 a month. You think $3,000 a month is going to take care of my life when I retire? Even if I'm staying in Baffochu in Santa, $3,000 is going to take care of me? You think so? So you cannot count on that, guys. You have to understand you are responsible for your retirement. That's why the government shifted a lot of responsibility, and many companies, shifted a lot of responsibilities from company-sponsored pensions to 401ks, where you, this worker, you, the employee, you are responsible for your life. Nobody is going to do that for you. That's what companies are saying. You own your life. If you don't invest in your 401k, you will suffer. If you invest, you will be good. They don't want you to hold them responsible. So there is no safety net. The only safety net is you. So if you're not doing the things that are helping you, you are not going in the direction with people who are heading in that direction, you are not seeking help, you are not seeking mentors, you are not finding ways by which you can get ahead in these things, you are going to suffer. Please. It's going to be hard. Anyways, it was a wonderful evening. I hope you learned something from the live. Have a wonderful rest of your evening. I'll see you during the next live show tomorrow night. Until the next one, be well, be blessed. And by all means, please drop me a comment, drop me a like on YouTube, follow me on Facebook, on Instagram, share this with your friends, invite more of them next time to join us. It was a great plumping pleasure having each and every one of you. And I'll see you tomorrow on the next live video. If you need a one-on-one attention, you want us to get a one-on-one diagnostic call, just look down in the description of this video. If you don't see it on Facebook, check on YouTube, check on my other Facebook videos. You are going to see the link, and it will be in the description or the comment section. Actually, on Facebook, it will be the comment. Book some one-on-one time for a small fee. Let's have a conversation. Let me get you started on investing for your future. And remember, this is how you build legacies, because in this community, I do very simple things. I teach people how to gain clarity on what is it that they want for their life. After they gain clarity, I help them protect what it is that comes in. Once we protect that, then we start multiplying what it is that is coming in. Once we start multiplying that money, then we accelerate the multiplication by bringing in additional money from side gigs, from different part-time work, whatever it is, so that we can get to the goal faster. And the fifth thing we do, we make sure we build a system around the money to perpetuate it. That's when we're talking now about wills. We're talking about trust funds. We're talking about all these concepts that sound foreign to our ears, but that's how the other people who are successful, that's how they build successful lives. They build successful lives by investing, because when you invest in assets, you can benefit from it while you are living, and when you're dead, the people who come after you will benefit from. I am not one of those who advocate for you to spend the next 20 years working hard and living like a miser. You cannot even buy one or two things you like, and you're trying to save money for the time when you are 70. No, 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 no. I'm not part of that group. It's important that you also live life as you get along. But the challenge with us today is that we are starting to live more and forget that there is also life at the time when we will not be working. So we must plan for that. We must balance it out, right? And one of the ways to balance it out is through clarity, because with clarity, you know exactly the things you want and the things you don't want. So you focus on the things you want, the things you're going after, the things you enjoy, and then you don't spend money on the things you don't enjoy. Where I am in my life today for the last few years, I'm very clear about the things I enjoy. So I don't spend money on the things I don't enjoy. As simple as ABC. That way I can spend lavishly on the things I enjoy and the things that bring value to my life, right? That's how you think about these things, guys. So I want to work on you. I want to change your financial identity. I want you to think about these things from a holistic perspective. Don't think about it only from the fact that you come online when Mr. Agachu is online and you get tips on what stock to buy. I will give you that from time to time, but that's not what I'm all about. I'm all about the holistic game, to transform your minds first, to transform your spirit, to transform your belief system. Because when those are transformed, it's easy now for you to see multiplication with your investments. It's easy now for you to be receptive to these ideas. Don't try to impress nobody with big language. Impress yourself first. Learn. Understand what is going on. Practice what I'm telling you. Go today at home, take the notes you've taken, do something about it. Don't just take information. You don't want to end up with information kwashako. Right? You don't want to end up with a big stomach because of information. You want to end up with a six-pack because you took information and the information came out through your brains because you put it into practice. Guys, always a joy to have you on the line. Have a wonderful evening. Until the next live show tomorrow. I'll be having a live at 7:30 in the night. Drop me a comment if you want me to talk on any specific topic. Feel free to do that, okay? Drop me a comment. Let me know if there's a specific topic you want me to talk about. Until the next time, you be well, be blessed, and by all means, never stop being a blessing to somebody. Bye for now.